Welcome back to Trading Hour on CNBC-TV18. We have the management of Happiest Minds joining in with us, Venkatraman Narayanan, the Managing Director, and the newly appointed CFO, Anand Balakrishnan of the company, joining in with us to talk to us about that. Anand, firstly, congratulations to you. It's been one happy week coming in for you for Happiest Minds at the CFO position. Before we start with the conversation moving forward, what are your key insights in terms of your focus area that you have for the company next 12 to 18 months? What do you look at it in terms of the growth for the company? Overall, FY25, around a 26% growth that we're seeing. Where are you envisaging moving on from here on? What do you want to work on here? Anand?
I think let Venkat take this thing. Okay, sure. Hello. I'm relatively new in this organization. I will defer it to Venkat to take this forward, and then I'll answer the other questions as well.
Absolutely.
Yeah.
Venkat,
go ahead.
Hi, Vinnii. Good morning. And yes, we are looking to grow into the next year. Last year, we came out of a decent year, 26% growth, like you rightly highlighted. It had a mix of both organic and inorganic growth. So we did reasonably well on that front. 2-3 years, we have shown compounded annual growth rate of about 22% plus in our revenue growth. So it's fairly been a good 3 years. If you look at it post-listing, we have kept on to that double-digit growth rate. And our endeavor is to make sure that we keep growing both organically and inorganically going into the next year, and meet or at least make an attempt to meet that aspirational growth target of $1 billion by 2031.
Gentlemen, good morning. Thank you for joining in. This one simple. I was reading about a note that came in the domestic brokerage note yesterday, and it mentioned that your inorganic growth plans, the inorganic acquisitions that you have done, will eventually start to fructify and will be instrumental in leading your growth and shifting your product mix towards the healthcare and the BFSI space. What are your plans are you guys doubling down on these two verticals right now because of the headwinds that you're facing in the EdTech segment? If you could share your rationale for that.
Sure. Early last year, we verticalized the businesses. So, EdTech was the lead vertical. Once you verticalized and you looked in future into the growth verticals that we needed to be in, obviously BFSI, healthcare, manufacturing, CPG, retail, these stand out. EdTech is something that we have been strong and we've been good at. But then the need to strengthen these other verticals was an imperative because, traditionally IT industry has grown consistently in these verticals. Acquisitions that we did nicely fitted into these verticals. So high tech, healthcare, and BFSI were the three verticals that got really, strengthened because of these acquisitions that we did. And we are continuously following up and building up on that trend to keep these three verticals growing. EdTech is something which has been traditionally very strong for us. But yes, there have been signs of slight weakness in that vertical, which we have shared with you in our earlier interactions as well. And, while we stand a very good chance to win any contract that comes into that vertical, the market itself has to be amenable to that kind of a growth aspiration from our side. So while all focus is on EdTech, we are also beefing up, or we are doubling down on growth of the other verticals, and this is towards keeping that double-digit growth that we had talked about the company.
Now, speaking of contracts, how's the deal pipeline looking like? Are you in talks? Are you in the course of winning new deals? What's the situation on ground currently?
While I can't speak to you about the quarter that's under progress, but we are seeing reasonably good growth in the quarter. Just to put it in perspective, last quarter we grew by about 1.1%. If you look at it in dollar terms, constant currency. This is despite, there was this fiasco that we had with one particular customer, which I covered ad nauseum. If you adjust for that one little mishap in our case, we did about 2.5% growth in Q4, it's been not the easiest of quarters for the industry. Now, coming off that, we are looking for a similar repeat of a similar kind of a number. In the quarter, we are seeing a good amount of existing business, falling in place, new business coming in from existing customers coming in. The deal flow has been good, I should say.
Right. What I want to also understand, Gen AI, right? Previously, you all have spoken about, believe that it will break even by FY26, the Gen AI side of the business, and will be profitable in FY27. Anand, if I could come to you in terms of your overall thoughts for Gen AI, as well as how large do you think it can actually be as a part of the company's business going forward? And in terms of margins, how does that work there?
Again, as I said, it's just been barely 2 weeks into this organization. I'm kind of pretty much in an immersion in a discovery phase. Venkat, why don't you take this up, and then probably, and I'll take it up later.
Yeah, I think Anand, the point here is, Vinnii, Gen AI, we had set a target for ourselves to do about $5 million in the second year or the first year of our establishment. We were about 50% of that. That's what the number that we have disclosed for the last year. We are looking at a similar number, which is almost a 50% growth going into the current year, which is FY26. Last year, it was an investment year, and I had covered this in all my earlier calls. It was a low utilization year. It was a setup year. It was a startup within a larger organization. So all support, all hands on the deck to make sure that the business takes off the ground. We had multiple conversations. We have opened multiple accounts, all of which we have spoken about. But coming into this year, we are reaching a state of maturity where first is our utilization rate, which was about 35 to 40% in the last year, which should come up to the 60 to 70% range. That should nicely take us to a break-even point, which you rightly pointed out. And then it should, the trajectory should be one of growth going into FY27 onwards. Coming to what should be the size, that's peering into the future a little bit. I think for any business unit to stand out and gain traction and be relevant within a larger environment, when we are about 500 million, it should be something close to at least 5% of the total business. So what I'm trying to say is it should be about 25 million in terms of revenues in the next couple of years for it to really gain traction. But while I say that, I should also be careful to say that just like IoT was a business unit and then it got absorbed into the BUs or into the verticals as we went ahead, Gen AI also could get nicely intertwined into the business as we progress, and it could just get integrated into our verticals and horizontal offerings that we offer to our customers.
All right, gentlemen, thank you so much for sparing time and joining us today. Wish you good luck for the rest of the year, and Anand, wish you good luck in your new stint as well. We'll take a short break here, but before we do that, CNBC-TV18 Access, a premium membership-based service available on CNBC-TV18.com, offering members exclusive content, market intelligence, and expert thought leadership. And the membership includes access to CNBC-TV18's flagship events, interactions with our journalists, along with curated studio tours, e-learning sessions, and masterclasses, and curated lifestyle benefits. Now, designed for an immersive and enriching experience, it empowers members with premium business intelligence and unique lifestyle benefits. The power of insight, the privilege of access, exclusivity, experiences, and influence is yours to claim. You can become a member by logging on to CNBC-TV18.com/access/plans.